All right, we can get started. Thank you, everybody, for joining us. We appreciate any time you spend with us. There's some new requirements in the state of California regarding employers with as little as one employee. So we always want to stay ahead of these problems and give as much information as possible to our clients and the community. We're really fortunate to have our partner, Roberto, on here with us today. He's our go-to financial advisor. We've worked for several years closely with him. His firm is in the city of Cerritos, but he's often here at our office working out of here and helping our clients. So we're happy to have him on today. I'm Rose, American Tax Planning. Most of you guys are clients that are on, so thank you for joining us. And again, we just try to stay ahead of these compliance problems so that way we avoid to self-educate, and then that way we're avoiding penalties and interest. So this is a big one, this new requirement. And now it's down, the deadline is down to December 31st for employers with as little as one employee. So we want to make sure that everybody's aware of it. We're getting close to the deadline, and some of these programs, you need several weeks to get them set up. So we just want everybody to be informed. So I will hand it off to Roberto if you want to introduce yourself, Roberto, and then we can go over our agenda.
Hi, everyone. Like Rose said, my name is Roberto Guzman. Thank you, Rose, for having me on. The primary goal of today's Zoom meeting is to help people understand what you need to do to make sure that you're compliant with the California requirements to offer a retirement plan before the end of the year. We're going to cover the types of retirement plans that would be eligible, the types of employees that are required to be participants, as well as some key areas that might help you make sure that when you're ready to set up that plan, things get rolled out as smooth as possible. So, starting with the state of California, they started requiring a retirement plan for companies 5 years ago, but they started with the larger companies, and every year they were requiring the smaller and smaller companies to offer the retirement plan. And some of the history behind it is that, for a lot of people that are in the current workforce, Social Security is not going to be enough to retire on. In today's world, people are living 20 to 30 years in retirement, and with the lack of funding for Social Security, there's just not enough resources for people to just rely on Social Security. So the state now has that mandate where if you have one employee or more, you're required to offer a retirement plan. But it's a little bit more than that. The requirements just don't end there. So, what does that mean for you as an employer? As an employer, it means that you need to offer a retirement plan, which could be, different kinds of retirement plans. It could be a simple IRA, it could be a 401k. And so those are typically the most common small business retirement plan solutions. And so if you don't want to offer a retirement plan, California has a solution for you that would be the California CalSavers plan. Now, there's a big difference between the California CalSavers plan and a traditional 401k or simple IRA. One, with CalSavers, you're required to enroll everybody that is an employee, and an employee is qualified as someone that works for you. Doesn't matter whether part-time or full-time, and they are on a W-2 payment schedule. So if you are a business owner that has a lot of contractors and you pay them 1099, they wouldn't qualify as employees, so you're not required to offer a retirement plan to them. But everybody else that would get a W-2 from your business, is considered an employee, whether they're full-time or part-time. So you're required to enroll everybody. Now, if they don't want to be part of the plan, it's their responsibility to unenroll themselves. But one of the requirements that CalSavers has is that you have to auto-enroll everybody, and you also have to re-enroll them every 3 years. And the money that goes into these accounts at CalSavers is not pre-tax, it's a Roth IRA. And the Roth IRA, for those of you that might not be familiar with how it works, a Roth IRA is a retirement account where you put money after taxes. It grows tax deferred and comes out tax free. Okay, but Roth IRAs have income limitations, and what I mean by that is if your income's too high, you don't qualify for a Roth IRA. And it depends whether you're single or married. So if you're a single person making $170,000, you don't qualify for a Roth IRA. If you're married, the number's a little bit higher. But what could potentially happen is that employers might have employees that, make $50,000, $80,000. And so the concern wouldn't be there, but they're not necessarily policing what their spouses make. And if the other spouse is making a significant amount of money, now you have an employee contributing to a Roth IRA that is not allowed to contribute to a Roth IRA. And so there's a lot of corrective action that happens years after you enroll people in the Cal Savers, just because no one's policing that. There's not a system of checks and balances that would help employers figure that out. Not to mention, you would be kind of asking all your employees what their spouses make, which some might feel it's really none of their business. So unlike a 401k and a simple IRA, those two retirement plans are designed to not have any income limitations. So you can make, a high income on the W-2 or a very low income on the W-2. You're still allowed to contribute to your 401k or to your simple IRA. Now, 401k is essentially a retirement plan that allows your money to go in on a before tax basis. Okay, so what does that mean? That means that for every dollar that you contribute to your retirement plan, it reduces your taxable income dollar for dollar. Let me give you a quick example. If someone's making $100,000 and they decide to put 10% of their income in a 401k, that means their W-2 is going to come out to $90,000 because to the IRS, they only made $90,000. That $10,000 that went into the IRA gets reduced from their income at the end of the year. So it's a great way to reduce your taxable liability. It's a great way to save for your retirement. And in today's world, most 401ks have a pre-tax bucket, which reduces your taxable income, as well as a Roth bucket, which allows you to grow the money tax deferred, just like your regular pre-tax, but allows the money to come out tax-free as well. Now, simple IRAs are also a popular choice in recent years, but there's quite a bit of there's a handful of differences that employers should be aware of. So if we were to compare side by side a 401k and a simple IRA, there's one feature that's significantly interesting that is something to be aware of. So for example, contribution amount. So a contribution amount to a 401k, the maximum you can contribute without dealing with any catch-up contributions is $23,500 for a 401k. For a simple IRA is $16,500. So there's a significant difference in terms of how much you can put into a simple IRA versus a 401k. Then we have catch-up contributions. The catch-up contribution for a 401k is an additional $7,500, and for a simple IRA is $3,500. So if you wanted to max out a 401k and you're at the age of 50 or older and you're allowed to put the catch-up contribution, you can put $31,000 into the 401k versus the $20,000 that you can in a simple IRA. The other thing is that simple IRAs require a 3% match by the employer to the employees. A 401k does not have a matching requirement. A lot of companies offer a 401k matching, but it's not a requirement. So it just kind of depends on how the owner sets up the plan and what they're thinking they want to do. The other key difference is that the investment choices are much greater inside a 401k than a simple IRA. Inside a 401k, you have a menu of investments. You have your age-based investments, which are the best way to describe those is kind of set it and forget it based on your age. Then you have individual funds that you can pick and build your own portfolio, as well as risk-based funds where if you just want to be aggressive, you just check that box and your investments are aggressive. If you want to be conservative, you check that box and the investments are conservative. Where a simple IRA, you have to go in there and build your own retirement portfolio within the confines of the retirement plan or the record keeper that is holding the simple IRA. So there's a huge amount of differences there. Also, from the employer side, they can always add profit sharing. Most of the time, it's a discretionary profit sharing to the plans, and that could be beneficial for retaining talent, as well as keeping kind of some of those executives uh, in the business for a little bit longer. But at the end of the day, what the state of California wants is everybody to have access to a retirement plan for their benefit in the future. They feel that Social Security isn't going to be enough to retire on solely. So they want to make sure that everybody has access to a retirement plan. Other than that, one of the things that you probably want to start thinking about if you're looking to set up a retirement plan is making sure that you are doing payroll. A lot of small business owners still kind of do payroll on their own, but when you set up a retirement plan, you're going to have to link that retirement plan to your payroll provider, wherever that is. And so make sure that you have that all set up as you go into looking at the retirement plan solutions for your business. It will make it much easier if you have that set up versus trying to set that up at the same time as you're doing the 401k. And the other thing that I always tell business owners to think about is where do you see, this retirement plan looking for you and your employees in the long run? If you really integrate this and you educate your employees about it and you help them understand how deferring some of their income in the retirement plan and the power of compound growth on what that could do for their future, it's really a nice additional benefit for them that right now they're not receiving. So the other thing that doesn't get discussed often is that a lot of employers that offer health benefits like health insurance, their health premiums are based on the age of the participants in the plan. And so studies have shown that a lot of older participants in the plan would have preferred to have been retired earlier, but they can't because they can't afford to retire because they don't have enough retirement savings. By providing a retirement plan early on, employees can start building their retirement nest egg and potentially retire earlier than they would have otherwise, therefore reducing the cost of health insurance to the employer in the long run. So I know it's not an immediate benefit, but it's something to think about in the long run. It's going to be something that the employer is going to have to deal with. And, if we can nip that in the bud now, why not? So,
Great.
any questions, Rose?
I do actually. So some technical questions as employer. So something that caught my attention was that minimum one employee, and that employee can be a part-time, and you're still mandated to offer. And then another question, because we have several clients on the call that are single shareholders of the corporation.
Mm-hmm.
So some of them are the only employee for the corporation. Are they still mandated to offer the benefit as well?
No, there. No, because it's just them. It's a one-man show. That's
Okay.
the only exception.
Okay. Do they have to opt out of anything or do anything formally?
No, so it's for them and their spouse. So it's like husband and wife type team. They're
Uh-huh.
not part of have a retirement plan.
Okay, but as soon as they add anybody else, okay, so another question, if that's the case now, and then the deadline passes 12/31, how much time do they have to offer a program for a new employee that they add anytime after the deadline of 12/31?
So it depends because when you set up a retirement plan like a 401k, many times there is a waiting period before you can participate in the 401k. The most common ones are 1 year.
Okay.
So let's say you add someone January 5th, well, and you open a 401k February 3rd. Well, that participant can't be part of the 401k because it probably doesn't have the 1 year waiting period requirement to be part of the 401k. However, the company still has to offer a retirement plan on file so they don't get dinged later on. And so the penalty for not having a retirement plan offering is $250 after 90 days, and then per participant, and then $500 after 180 days. So if you didn't offer a retirement plan, within the next 12 months, there's a potential penalty of $750 per participant that the employer could pay.
Got it. Okay, great. And then, um, what is the lead time that a program like this takes to get set up? Two, if someone chooses to do it themselves on CalSavers, which just hearing you explain that as an employer, I don't think I would ever want to get my hands in. But so that time frame, working with CalSavers, do it yourself, or working with an office like yours, what's a time frame that someone needs to get set up?
With CalSavers, because it's a simple IRA, it might take, a week or less, depending on how savvy you are with, your online tools. When we're setting up a 401k, what's happening right now in California is everybody is trying to set up the 401ks right now just to meet the deadline. So a lot of the record keepers, like John Hancock, Nationwide, Fidelity, all those, are really busy trying to meet this surge of demand. So right now, our lead time is about 4 to 6 weeks to set up the plan and be ready for January 1st payroll.
Okay, got it.
No, and that's assuming they want to start offering it for 2026. If they want to make it retroactive from January 1, 2025, like we have to start working on that like ASAP, just because there's a lot of people that, kind of waited till the last minute to try to get these up and running, and we're all hitting the same bottleneck.
Got it. Okay, we have a question in the chat. Would this count for a contract worker that you 1099 or only full-time / payroll employees?
So it would only be for your full-time or part-time employees that would receive a W-2. If you're giving someone a 1099, they don't qualify as an employee, and therefore you're not required to offer them a retirement plan.
But part-time too.
Yes.
I think that's my biggest takeaway, is that part-time is considered employee. Okay, great. Any other questions? Okay, so and Roberto he's working with our office. He has ours set up for us. But any other advice for someone who doesn't have it set up yet?
The other thing I would just also like to share is that when you open up a 401k, there's up to $5,000 in tax credits that you can receive for opening up the 401k. And those tax credits could be used over the course of several years. And so, don't let the cost of the retirement plan scare you away, because there are some tax credits that could, eliminate all, if not all, the cost of setting up the 401k through these tax credits. And as a reminder, a tax credit is not the same as a tax deduction. A tax deduction reduces your taxable liability at a percentage rate. A tax credit eliminates tax liability dollar for dollar. So it's a big difference when it comes to tax credit versus tax deductions. And Americana and her office are pretty aware of how that works, and they can help you make sure you take advantage of that.
And then another question for me as employer, if we come into this program and we are offering a certain percentage match, the employer match, can we adjust that like anytime we want, or is that like if we want to increase, or how does that work?
So typically, with 401ks, there's annual testing that happens. And so if everybody is putting the, very little into the 401k, but you have some owners that are putting a significant amount, there's a good chance that 401k might not pass tests. And so to fix that, you just offer a 3% match across the board. And so the way that works is that, for every dollar they put in, the employer puts a dollar up to 3%. Now, if you want to add more to that, what we do is we amend the 401k plans and we add another feature, which would be profit sharing. And a profit sharing typically is a discretionary contribution made by the employer to the employee's account on a year-by-year basis. So if you had a really good year, you can add, profit sharing to the employee's accounts on the formula base, which helps just kind of keeping, the books under control and the overhead under control, versus having to adjust that much match every year up or down. So it's much easier for the employer to say, hey, I don't want to be on the hook for a 5% match just because we had a really good year last year. I'd rather see how it goes this year. And, if we have another good year, I'd like to give them something through their retirement plan. How can we accomplish that? And that's where the discretionary profit sharing comes into place because it's not a requirement, but when the employees get it, they're sure to be happy about it.
Got it. Great. So we had two people ask for either slideshow or bullet points. So we'll make sure to get you guys a checklist of all the items that Roberto's talked about, which includes the deadlines and the important information regarding employee versus contractor, and that even a part-time employee qualifies for this requirement. Let me see. What else? What else is important, you think, for employers?
Um, it just kind of depends on the size of the business. If you have, if you have more than 10 employees, you should have the 401k plan up last year. But with those, there are new requirements. The IRS requires a 3% match. If you have less than 10 employees, you're not required to give a match on the 401k. So just also a heads up on that. I just saw a question on the chat around Roth IRAs. And yes, we are familiar with the Roth backdoor IRA strategy. Essentially, what we do here in our office is we set up a non-deductible IRA contribution every year, and we convert it to a Roth IRA the following year, essentially creating that backdoor Roth IRA strategy. So if you want more information on that, the office will send out my information. Feel free to reach out.
Great. All right. Any other questions anybody has? Take advantage of Roberto's knowledge. He's very sophisticated. Anything else outside of the retirement that you want to remind all of our, for the most part, we have S Corp owners on this call. Anything else that's of importance, Roberto?
No, I would just say that, at the end of the day, a 401k is going to be a great benefit to your business. It's going to help you as a business owner keep control of your taxes, and it's going to be able to provide some sort of retirement stream of income, either taxable or tax-free, depending on how you fund it. And just gonna allow for, retaining some of that talent that you want, because the younger generations want those benefits. And sometimes, they'll go out looking for companies that offer that. So, and just keep it simple, or keep a 401k simple. Just, I'll allow the pre-tax contributions, the Roth contributions, 3% match, and call it a day. As the business grows, you can always amend your 401k and add other features that might make sense. But at the beginning, just kind of keep it simple. We offer a complimentary consultation with anybody that's interested in kind of running some numbers and looking at what different retirement plans are out there and kind of comparing them. But yeah, we don't have a lot of time left before the end of the year. So with the holidays, right around the corner, if this is something you're going to be required to do, might as well get started now.
Yes. We have two questions. Someone asked, did I hear right? If you have more than 10 employees, we have to do a match.
Yes.
Okay. Okay. And then second question is, what information can you provide for a self-employed 401k? What 401k options are available? And is it tax deductible?
So a self-employed 401k typically is also called as a solo K. And that's because it's for a one-man show. So there are a handful of providers that offer those. There are not as many as there used to be. But we could definitely, share some information. Just reach out to our office and be happy to kind of consult with you and kind of give you your choices on the solo 401k providers out there, because there's not a lot anymore.
Got it. And then there might be other products available that would be a better fit, right? Once you are able to assess someone and their business and their profits, versus a solo 401k.
Yeah, solo 401ks, kind of help that individual business owner. But many times when we sit down and talk to them, more often than not, a step buyer seems a little bit of a better option, just because they have more flexibility, they have more investment choices, and it doesn't have to be done through payroll. So, there are sometimes other choices besides a solo 401k, but it's on a case-by-case basis.
Got it. Perfect. And we're gonna send out an email from Roberto with all the information that he covered today, also his contact information. But Roberto, what's the best way to contact you for an assessment? Because you do no cost consultations, correct?
Yeah, we always do a free consultation, just to understand what's going on. It could be 30 minutes to an hour, just to assess the situation, and then from there we can tell you, what we could do for you, and you decide if you want to move forward. The best way is just to contact the office or email me. You know, my email is roberto@newgrowthfs.com, and when you send out the info, we'll make sure that we add your phone number in there as well.
Yes, we'll do that. Perfect. All right. Any other questions before we wrap it up?
All right, guys. Well, thank you for the opportunity.
Yes, thank you for joining us. We appreciate everybody on here. We'll get the recording out and the items that Roberto covered out to everybody via email, as well as Roberto's contact information.
All right.
All right. Thank you all.
Take care.
Bye.